Today, inflation ain't no snowflake. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, stocks have enjoyed an upbeat start to the year on hopes that the Fed will abandon its hawkish rhetoric and pilot the economy to a soft landing. In fact, traders are betting that the Fed will raise its benchmark rate to a peak of 5.1% in July, largely in line with the forecasts of Fed officials. And many in the markets are spinning a yarn about how the inflation rate will drift lower, bobbing on the wind like a snowflake, melting away to a nice round 2%. Well, I have to tell you, I think that the snowflake we're talking about here is in the eye of a hurricane, literally the calm before the storm. The story of a quiet adjustment is at best misleading and at worst an opportunity for others to transfer risk to the unsuspecting and to make money off their backs. It's actually a parallel to those property market experts who keep saying that the property market is about to recover and that you should buy now. All this is fiction, as the macroeconomic backcloth points to something else and much more destructive. Soon the hurricane will be in full force. And it's likely that the US economy will be in recession by the second half of 2023, which flips upside down the widely held belief that the first half of this year would be weak, but the second half would be stronger and a rebound into stocks and GDP. And of course, if the US goes into recession, then other economies, including Australia, will get caught in the downdraft. Now, some of this is just pure numbers. So, for example, if you want to see inflation around 2%, that'll only occur if the labour market is faltering along with earnings per share and GDP. At this point, US GDP increased at 2.9% in the fourth quarter. The unemployment rate fell to 3.4%, while the baseline inflation slowed from 9.1% in June of last year to 6.5% by December. Hence, there exists the current hope that inflation will slow to 2% while growth remains strong. But the road from inflation at 6% to 2% or even 3% would be much more difficult given the stickiness of wage inflation, which is currently at about 5% year over year. And it's likely that inflation will not fall as quickly as the goods sector, specifically services. The reality is that real GDP increased by just 0.8% for all of last year. That is, if you believe that CPI increased by only 6.5%. So in truth, the economy is not as strong now in real terms after you factor in the inflation issue. But by the way, Powell, of course, is still convinced that GDP is strong. And then geopolitics is also in play because China's reopening is, of course, good news economically speaking, but the truth is China will be fully reopened in the first quarter and they can't reopen twice. China did indeed pull the global economy out of the crisis during the Great Recession. It did this by increasing debt from 143% of GDP in 2006 to over 300% today. But in the process of taking on the greatest expansion in history, China created a massive misallocation of capital and a huge fixed asset bubble. China's economy is now so unstable that it cannot undergo anything close to the same process that boosted global growth just 14 years ago. The PBOC injected the equivalent of $581 billion over the past 2 months in preparation for their reopening. Clearly that pace of stimulus cannot continue without creating runaway inflation and a yuan currency crisis, let alone rescuing the global economy yet again. In fact, most importantly, China can only reopen once. Therefore, the growth impulse will peter out over the course of the next few months. And as I've discussed before, the Treasury Department in the US is actively offsetting quantitative tightening by emptying the Treasury General Account at the Fed. The Treasury parks money at the Fed, but the Treasury can draw it down during times of emergencies like now, due to the US hitting the debt ceiling. Secretary Yellen cannot issue new debt only roll over expiring debt. Therefore, she is tapping the TGA, which is adding new money into the economy. It's a type of QE that is for now offsetting the Fed's QT program. But the TGA will be tapped out come June, so this boost to the money supply is short-lived unless they lift the ceiling, which is possible but politically questionable. The Treasury General account at the Fed will need to be replenished, and that will exacerbate the $95 trillion per month QT program at the Fed. So come June, it'll be QT plus. Oh, and by the way, the tax loss selling at the end of last year caused sellers to pile back in after the 30-day wash sale rule expired. The beaten down profitless tech sector lost 70% of its value last year. Investors realised those losses in December and then had to wait 30 days to lock in those write-offs. And by the way, a stock down 70% needs to increase by 233% just to break even. So who cares if stocks are up just 30%? And in any event, that caused a cascade of buy volume into this sector through the month of January. But that rush back into losing bets is over and done now. And these profitless tech investors are likely to witness their companies going out of business because they cannot afford to service new debt at the much higher interest rates. And overall then, we'll be left to endure the lagged effects of the most coordinated global tightening of monetary policy in history that took place over the past year, which has yet to fully hit economic growth and EPS, but will absolutely do so by the end of the second quarter. And of course, the yield curve continues to sink further into inversion, which is a leading indicator of trouble ahead. It's actually the most inverted since 1981, which warns that this may not just be an ordinary recession, but one that is extremely difficult. The cost of capital for zombie corporations and consumers have surged over the past year, and that'll cause massive layoffs from the 20% of listed companies that need to issue new debt just to pay interest on existing obligations. So put all that in your pipe and smoke it, as they say, and really no surprise that US stock indices ended lower on Thursday, raising earlier gains as Treasury yields rose after an auction of 30-year bonds went poorly and overshadowed strong earnings from corporation giants like Disney and PepsiCo. Wall Street's three main indices had in fact opened higher on Thursday after data showed initial claims for state unemployment benefits rose just 13,000 to a seasonally adjusted 196,000 last week, above a forecast of 190,000 claims. But the Treasury story was the key downward force. The stock market started today's session with a distinct bullish bias, but then Treasury yields moved up, and that took some of the steam out of the positive market today, said Jason Ware, Chief Investment Officer at Albion Financial Group. And he said, investors were still digesting recent comments from Fed officials. In fact, yields on the US 30-year note rose after the Treasury Department saw a weak demand for a $21 billion sale, the final sale of $96 billion in coupon-bearing supply this week. In a note to clients, Jeffrey said the buy-side bid failed to come together. With Treasury yields higher, it becomes a legitimate alternative to equities, said Michael Rosen, Chief Investment Officer at Angels Investments. The 210 Treasury yield curve inverted by 85 basis points. That's the deepest inversion since early 1990s, triggering fresh worries about economic troubles, just as investors price in a more hawkish Federal Reserve. And it's worth just noting again that some of the recent surge in layoffs will start to push jobless claims higher later in the year. The big picture here is that the surge in layoff announcements reported in the Challenger survey will pass through into claims by late winter, early spring, allowing for the usual lags, Pantheon Macroeconomics said. The plethora of hiring freezes and layoffs announced over the past couple of months will begin to greatly inhibit consumption, and the battered US consumer, two-thirds of whom are living paycheck to paycheck and have less than $400 in savings, should begin to shut down consumption. And the economy will also be struggling through a Fed funds rate that is stuck above 5% for a long time. Most importantly, the great cascade of the base money supply and Fed credit should cause bank lending to begin to seize up and cause chaos in credit markets. The coming recession will push the current mild decline in EPS into a significant plunge. Now, of course, this will eventually lead to a genuine Fed pivot, but it will come in response to an equity market crash and credit market freeze, not ahead of one. So the Dow Jones Industrial Average closed 0.73% down to 33,199 on Thursday. The S&P 500 lost 0.88% to 4,081. The Nasdaq Composite dropped 1.02% to 11,789. In fact, weighing on the S&P 500 and Nasdaq, Alphabet extended losses from the previous session to fall 4.7%. And the Google parent's new chatbot shared inaccurate information, as I discussed previously on Wednesday, feeding worries that it is losing ground to rival Microsoft. Disney did beat earnings estimates and announced job cuts, encouraging activist investor Nelson Peltz to terminate his quest for a board seat. Still, it ended down 1.27%. Salesforce rose 2.38% on reports that hedge fund Third Point owns a stake in the company, and PepsiCo rose 0.95% as the snack and beverage maker reported better than expected results, while drug maker AbbVie gained 2.82% after beating fourth quarter profit expectations. Tapestry soared 3.47% on a strong annual profit forecast. So now that more than half of the S&P 500 companies have reported quarterly earnings so far, we find that around 69% of them have beaten estimates, according to the latest data. But what of earnings ahead if my reading on macro is correct? Because the truth is that as the eye of the hurricane moves away, we're going to get caught in the full blast. It's not going to be pretty. It's not going to be kind. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.